what an asset is future deferred consumption. You buy an asset to maintain value so you can do something with it. Now, the S&P's done a good job at offsetting debasement, but it hasn't gone up. So you haven't actually got richer. You've maintained the same. Gold has done a terrible job in all of this.
Right.
Real estate does underperform, but don't forget most real estate uses leverage, so it actually probably ends up a bit better. So it probably looks more like the S&P. But none of these things have added to your wealth. The only things that have added to your actual wealth, i.e., your ability to buy more in the future of other assets or whatever, is technology and crypto.
Raoul, the founder and CEO of Real Vision, predicts a remarkable bull run for cryptocurrencies and technology. He believes that these two asset classes will spearhead the next phase of the exponential age, where the fruits of past technological advancements will materialize at astonishing speeds. According to Powell, this age will be characterized by high-tech innovations and incredible technological forces that will make our daily activities faster, more productive, and easier. He argues that the push for this next era of human evolution has become imperative due to the failures of existing financial and economic systems. Powell asserts that a global economic reset occurred in 2008 when major economies realized that the key factors for GDP growth, demographic and productivity growth, were either stagnant or declining, while debts continued to accumulate and reach alarming levels. In response, central banks resorted to putting debts on their balance sheets and printing money periodically to maintain economic balance. However, Powell suggests that this strategy has resulted in a point of no return, as continuous liquidity injections have become necessary to protect the fragile economies. He believes that central banks will continue pumping money into the economy, driving asset prices up in the short and long term. On the flip side, Powell argues that traditional asset classes are not experiencing real growth in terms of value appreciation. Instead, they are merely responding to the influx of liquidity without a genuine increase in purchasing power. Powell's thesis centers on the notion that productivity growth is the key to escaping the current GDP disaster. This is where crypto technology and the exponential age play vital roles, leading Powell to hold a bullish stance on these asset classes. He emphasizes the importance of his insights in a master class and encourages not to miss out on this valuable information.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
It's difficult to put it all into one place, but essentially the world that we knew is broken. It's broken because of demographics. So if you think of, I call it the magic formula. What is GDP growth? GDP growth is basically population growth plus productivity growth plus probably debt growth. And debt growth kind of robs the future to create current growth. And when you look at those three factors, most of the Western world plus China are seeing shrinking populations. The US is kind of flattening, not shrinking, which is why the US trend rate of GDP growth is somewhat higher than Europe and Japan, and China's still a bit different because of the stimulus packages. Then we look at productivity growth, and it's been declining for a very long time now. And so we have a decline in productivity, either declining population or slowdown of population growth, and debt growth reached its limit in 2008. And this is the key part. So really what GDP growth does is finance investment and also debt payments. When a government gets to 100% of GDP in debt, which the EU, Japan, US did, and UK's just done so last week, if they're 100% in debt and the trend rate of GDP is, let's say, 2% to make easy maths, and interest rates are at 2%, 100% of GDP growth goes to paying interest.
Right.
Because every year you've got to pay the interest that needs to come out of GDP. So that means the economies wouldn't grow. Now, it used to be covered up by debt growth, but what happens now is that the private sector is over 100% of GDP in debt as well. So you're competing for the GDP to service the debt payments. And the answer ended up being in 2008 is we will just put it on the balance sheet of the central bank. And the Everything Code, part of the Everything Code, which is a very big, broad thesis, proves, as much as I can, that all interest payments are just the monetization of the debt from about 3.5 years ago. Why 3.5 years ago? It's this 3 to 5 year window. The economy has come very cyclical because in 2008, we actually got the great reset that people have been waiting for. The reset was saying, okay, interest rates don't count anymore. They're all going to zero. So everybody can service their debt. Right? People haven't framed it in these terms, but that's what it was. And then everybody refied their debt. And governments have generally, and corporations generally have refied in the 3 to 5 year sector. So you get this 3.5 year cyclicality of the economy, that debt payments come due, the economy slows down, rates get cut. We keep going through the same cycle over and over and over again. This one got somewhat skewed by COVID and what it did to demand, supply. So it created a larger inflation shock. But generally, the framework is still there, that the central banks need to monetize the interest payments or the economy compounds negative forever. That's a big thing to get your heads around. And I've proven that the US has done it, Europe's done it, Japan has done it, and the UK have done it. I think there is a global central bank agreement that they need to keep interest rates down below trend rate of GDP growth when it comes to rolling these payments.
In previous interviews and tweets, Raoul has extensively discussed the strong correlation between business cycles, global money supply, and asset prices. His latest thesis, The Everything Code, delves deeper into this correlation and how it can assist investors in timing the markets effectively. Powell believes that the liquidity cycle typically occurs approximately every 3.5 years, with intermittent slowdown periods often marked by recessions. According to the macro expert, we bought them last October, and the printers are about to come on again. Stay tuned for more clips from the interview to gain further insights.
That is the key part. And those interest payments are what's driving up the central bank balance sheets. The central bank balance sheets are liquidity, and we'll talk a bit about the liquidity element later. But what they actually are is debasement of currency. You're basically borrowing money to pay off the interest on the other money. And that's a pure debasement of currency. And that optically makes assets go up in price. Optically, because it's actually the denominator that's falling and not the asset prices. So with part of the Everything Code, I changed the denominator for all assets to the global central bank balance sheets and found out that most markets had gone nowhere once you look at it in those terms. They all look more like Europe did, which was a sideways ranging market. And that was the S&P went nowhere, real estate went nowhere, gold went nowhere. But there were two that did, which was technology and crypto. And I'm like, what's that all about? And that was this realization that got me to the exponential age, which preceded this whole thesis, that those are not only driven by the debasement, but they outperform because they're driven about technological adoption. So they're driven by Metcalfe's law and other factors. So what I then found out is when we built a liquidity formula for GMI, myself and Julian Bittel, and we found that according to our measures of liquidity, the NASDAQ, the S&P, all of these things, let's use the NASDAQ, 97% correlated with liquidity, particularly the central bank balance sheet, because it's the denominator. And we can then forecast into the future by using a lot of the work that we do in GMI, where liquidity is going to go. We also know what the central banks are going to do because they monetize their debt 3.5 years later. So we can actually build out models into the future where we think liquidity goes. And if assets are 97% correlated, we can forecast assets out into the future as well, which is what makes it an Everything Code. Now, it's a hypothesis, a thesis, needs to be tested. It's very bullish on assets going forwards because we're in the point in the cycle where economic growth is falling, inflation is falling, unemployment will start rising. And at that point, you tend to get stimulus over time. And we've seen the central bank balance sheets. The Fed used theirs for the banks. We saw Japan with the yield curve control. the UK bailing out its pension system. So bit by bit, we're starting to see the return of the debasement. And over time, it should accelerate at this point in the cycle. And that gives us a very good backdrop to assets, particularly crypto, which is the fastest horse in the race.
If you look at the S&P 500 relative to the Fed balance sheet, zero excess return. When you look at real estate and gold, net losses.
So what that means, because people are like, okay, I don't really understand what it means. What it means is you've got no wealthier by owning the S&P 500, even though it's gone up.
Right.
So what an asset is future deferred consumption. You buy an asset to maintain value so you can do something with it. Now, the S&P's done a good job at offsetting debasement, but it hasn't gone up. So you haven't actually got richer. You've maintained the same. Real estate is the little bit confusing. Well, gold, let's deal with gold. Gold has done a terrible job in all of this, which was surprising to me. I thought it would have done better. Right. Real estate does underperform, but don't forget, most real estate uses leverage, so it actually probably ends up a bit better. So it probably looks more like the S&P. But none of these things have added to your wealth. The only things that have added to your actual wealth, i.e. your ability to buy more in the future of other assets or whatever, is technology and crypto.
According to Raoul, despite appearances, it has become more challenging for the average American to purchase assets like real estate in real terms compared to 3 or 4 decades ago. This is because wages have not increased since 1972. Powell asserts that relying solely on wages for wealth growth is financial suicide. Instead, he suggests investing in assets like cryptocurrencies and technology to maintain purchasing power and achieve more significant financial outcomes. Tell us your thoughts on his detailed analysis of the Everything Code and the continuous liquidity loop maintained by the Federal Reserve. Please leave your comments and observations in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.